Hi, this is Scott Murray. Welcome to the Daily Economic Market Shout for St. Patrick's Day. It's March 17th, 2023. Today we got consumer sentiment. This is out of the University of Michigan, and it looks at real-time how consumers feel. What's interesting, financial crisis. We've had banks go bankrupt. We've had liquidity issues. We've had markets going up and down. How have they impacted the consumer? The answer is not much. When you looked at roughly 85% of the surveys were done before the crisis. After the crisis, those 15%, we are seeing the same type of responses, even with groups that have a high concentration of purchasing of stocks. What does that tell us? That tells us it's probably not going to move the needle a lot, right? This is not a Main Street issue. This is a financial issue involving the relationships of the Reserve Bank system. Reserve Bank system, in its principles, keeps 10% of the deposits for reserves and then loans out the other 90%. Those can be loans or they can be investments. They can be a whole bunch of things under our banking system. But when everyone wants to grab the money out of the bank at the same time, when it exceeds 10% of the deposit base, it's going to be a struggle. And I think that's kind of continuing what we're seeing out there. But let's jump back into the consumer. Yes, the consumer did move down. We saw a similar decrease in both expectations and in current conditions. And there is some sagging of expectations about financial income going forward, meaning is your income going to rise over the next several months, or is it going to fall over the next several months? And what we're hearing is there's a little bit less. But what's noteworthy is maybe a little tick up in inflation. Where it's getting hard is for low-income people, low-educated people, and for individuals who are struggling on the environment, particularly the young. So low income, low education, and young. That's a group that had done not bad. Remember, they were the group that we saw the initial 30% decline in spending in March of 2020. Then they got checks and they came back to roughly even by the end of the year. Additional checks moved them forward. So that group had actually done reasonably well with the job gains that we're seeing out here and an increase in wages because they saw a lot of the benefit to the wages. That bloom is coming off the rose, and that is actually pushing down these sentiment numbers. Now, in terms of the overall reading, when we look at buying intentions, we still see that elevated compared to last year. And I think that's the real important number. It comes below January and February, but it is still above what we saw in every month. There was one little sharp increase month last year, but in every month we saw last year. So the consumer is still thinking about buying, and these questions focus a lot more on durable goods. So they're interested in buying durable goods. Given higher interest rates, because we usually buy durable goods on credit, and when we think about the inflation impact on durables, that's really showing a resiliency to the consumer. And so as these markets move around, as we deal with some of the elements of a reserve system that can create somewhat of a volatility around these things and could actually further impact employment on the financial services side of the equation, and maybe a little bit in the tech. FinTech is a major component of our economy. Those jobs, high paying jobs, may have some weakness. And so we could start seeing a rise in initial claims and a sagging in non-farm payrolls pick up to the point where we might go negative in that column, even though we've been reasonably strong over the last years. So that's to keep our eyes open going forward. But a major shock to the system where consumers are refusing to purchase, that's not in the numbers. This is Scott Murray with the Daily Economic Market Shout. Thank you for joining me.